In 1932, a United States Senate committee began an investigation to determine if the collapse of the American economy had been a preventable failure. Investigators compiled 10,000 pages of testimony, revealing a series of orchestrated financial maneuvers that effectively funneled wealth to the royalty of Wall Street, while the rest of the country faced ruin. This systemic imbalance traces back to December 1918. While the First World War left the nations of Europe financially shattered, the United States emerged as a global creditor with unprecedented levels of domestic prosperity. During the war, the government introduced the Liberty Bond, a way for citizens to lend money to fund the conflict for a guaranteed return. By 1919, 66 million Americans had participated. For over half the population, this was a practical introduction to the concept of earning passive interest on their savings. This massive public participation essentially created a new class of amateur investors, providing the raw material for the financial explosion of the next decade. This new interest in wealth coincided with the arrival of consumer credit, a system that allowed families to purchase radios and cars using future earnings. While consumer goods were becoming accessible, the stock market remained exclusive. In the early 1920s, Wall Street was a closed network of elite bankers who operated without any federal oversight or regulation. The combination of a credit-hungry public and an unregulated financial elite created a structural vulnerability that few in power were willing to acknowledge. A banker named Charles Mitchell realized he could commodify this market by opening brokerages across the country, selling corporate shares directly to people who had never previously owned stock. This chart shows the difference between investing, valuing a company on its actual profits, and speculating. Brokers began selling shares based on speculative hype, driving prices to levels that had no connection to a company's real-world value. This visual breakdown shows a practice called buying on margin. It allowed a person to buy $100 of stock using only $10 of their own cash, while borrowing the other 90% directly from a bank. This created a precarious cycle. Investors relied entirely on the stock's rising prices to pay the interest on their loans. If the market stopped growing, the entire debt structure would collapse. While the Wall Street elite actively inflated this bubble, political leaders like Herbert Hoover supported the era's hands-off approach, trusting the market to self-correct without government interference. By the late 1920s, the American economic boom was a fragile construct, built almost entirely on layers of borrowed money and speculative optimism. In October 1929, the bubble reached its limit. As investors realized stocks were overvalued, they rushed to exit their positions, triggering a mass panic that saw the market lose 11% of its value in a single morning. The heads of the nation's largest banks met at J.P. Morgan to organize an emergency bailout, pooling over $100 million to buy stocks and artificially stabilize the prices. The intervention failed. On Black Monday and Black Tuesday, the panic returned with even greater force. $25 billion of wealth vanished in days as millions of sell orders hit a market where there were no remaining buyers. The crash exposed the math of the debt. Once the public stopped believing prices would rise, the margin loans became impossible to pay, and the entire financial system began to seize. The collapse quickly moved from the trading floor to Main Street. When investors defaulted on their margin loans, the banks that had issued the credit were left with massive holes in their balance sheets. Because there was no government insurance for bank deposits, a bank failure meant the total loss of all customer funds. People who had never owned a single share of stock saw their life savings disappear as their local banks closed their doors. This sparked a massive housing crisis. In New York, the newly homeless built shantytowns of scrap wood and cardboard in Central Park, creating a visible reminder of the collapse within sight of the wealthy skyline. The 1932 election brought Franklin Delano Roosevelt to power. He established the FDIC to protect bank deposits and empowered the Senate to investigate the causes of the disaster. The investigation uncovered rampant tax fraud, the theft of client funds by bank presidents, and secret kickbacks paid to high-ranking politicians in exchange for a lack of oversight. These findings indicated that the Great Depression was the logical result of systemic fraud and a complete lack of accountability at the highest levels of American finance. The crisis became global as American banks halted the loans that were funding the reconstruction of post-war Europe. This sudden withdrawal of capital caused an immediate industrial collapse across the continent, leading to hyperinflation and mass unemployment in nations like Germany and Italy. As the global economy failed, millions of desperate citizens lost confidence in democratic capitalism and began supporting authoritarian leaders who promised economic stability through total state control. This environment of financial ruin provided the necessary leverage for figures like Mussolini and Stalin to solidify their power and dismantle the existing international order. The crash of 1929 serves as a stark warning. When a major financial center allows speculative greed to outpace regulation, the resulting collapse destabilizes the world and alters the geopolitical landscape for generations.